A massive merger created an entertainment powerhouse, but also a staggering financial burden. Behind the glitz of Hollywood lies a balance sheet weighed down by colossal obligations. The dream of synergy between media giants came with an enormous price tag attached. Billions borrowed to build an empire now threatened the stability of its foundation. Content libraries expanded, but so did the pressure to deliver constant profitability. Streaming ambitions collided with harsh financial realities and slowing subscriber growth. The industry's golden age of expansion turned into an era of cost-cutting and caution. Debt restructuring became a daily discussion in boardrooms once focused on storytelling magic. Revenue streams from cable declined faster than anticipated, tightening financial flexibility further. Legacy networks struggled to maintain relevance in an aggressively digital entertainment landscape. The once celebrated merger promised efficiency but instead revealed layers of operational complexity. Production budgets faced cuts, reshaping the creative ecosystem within the entertainment giant. Advertising slowdowns magnified the financial squeeze across both streaming and broadcast segments. Pressure from investors grew as profitability targets became harder to meet. Every quarterly report became a test of confidence in the company's long-term vision. Interest payments alone consumed billions, diverting resources from innovation and new content creation. Executives focused on monetizing existing assets instead of aggressive new expansion. The weight of debt began to influence every major strategic decision moving forward. Content prioritization shifted from quantity to quality, from ambition to necessity. Streaming platforms merged and evolved, aiming for efficiency over experimentation. Partnerships became crucial, offering short-term relief amid ongoing financial turbulence. Debt reduction plans were announced, signaling a shift toward long-term sustainability. Non-core assets faced potential sales to stabilize the company's economic health. Every move was scrutinized by analysts seeking signs of financial turnaround. The entertainment world watched closely as debt reshaped creative priorities. Ambitions of dominating global streaming were tempered by fiscal responsibility. Brand consolidation aimed to simplify offerings and reduce overlapping operational costs. Creative divisions felt the ripple effects of restructuring and tightened budgets. The once unstoppable expansion of content slowed under the burden of liabilities. Debt management overshadowed innovation, forcing pragmatic decisions across every department. Focus shifted to maintaining profitability amid uncertain market conditions and rising competition. Consumers continued to demand premium content, but financial limits constrained production. Global ambitions met the reality of an increasingly saturated streaming landscape. The company's valuation fluctuated as investors assessed long-term financial resilience. Debt negotiations with lenders became a balancing act between pressure and patience. Market analysts warned that creativity alone couldn't offset structural financial challenges. Leadership emphasized debt repayment as a top priority over rapid business growth. Strategic alliances emerged as lifelines amid growing economic strain. Cost synergies were realized, but not enough to offset immense interest obligations. Financial prudence replaced the once dominant spirit of industry-wide expansion. The entertainment empire redefined itself under the weight of fiscal responsibility. Reorganization aimed to align creative ambition with economic discipline and investor trust. Analysts debated whether the company could sustain innovation under tightening constraints. Every new show and film carried the expectation of measurable return on investment. Market confidence depended heavily on visible progress in reducing the massive debt load. The brand's legacy of storytelling now intertwined with lessons in corporate endurance. Resilience became the silent driver behind every executive decision and creative strategy. Debt, once viewed as a growth enabler, became the symbol of restraint and reflection. The $50 billion challenge stands as a test of adaptability in modern media. Through turbulence and transition, the company seeks balance between art, ambition, and accountability.